to see every one of you, to see we already have 100 attendees, which is great. So my name is Serhiy Kiyashko. I'm a senior researcher at the National Bank of Ukraine. I'm also an assistant professor at Kiev School of Economics, and I will be the moderator for today's event and also for future days' events as well. So National Bank of Ukraine, together with the National Bank of Poland, traditionally organizes the annual research conference. And the topic of this year conference is the policy toolkit for a world in a flux, which will take place this Thursday and this Friday. And as a part of annual research conference, we usually organize 3-day online lecture course for students and for PhD students, for lecturers in Ukraine and not only in Ukraine, so that star speakers which attend this conference, which present at this conference, could share their experience, their knowledge with Ukrainian students. This year we have 3-day online lecture course on Monday, today, Tuesday, tomorrow, and on Wednesday, the day after tomorrow. The agenda for 3-day online lecture course is as follows. Today we are very glad to have Archil Mestvirishvili from the National Bank of Georgia. He is Deputy Governor. And Archil will present a lecture about anti-crisis policy of central banks in times of uncertainty. Tomorrow we will have Sofia Kazinnik at 4 p.m. from Federal Reserve Bank of Richmond with presentation about measuring central bank communication using machine learning. And on Wednesday at 1 p.m. again, we will have Giovanni Rico from University of Warwick with a presentation about domestic and international effects of US monetary policy. We hope you'll enjoy these lectures and also join us for the big conference, for the annual research conference on Thursday and Friday. Let me say a couple of words about Archil. Archil is a deputy governor and board member of the National Bank of Georgia since 2009. His main responsibilities are monetary policy design and implementation, macroeconomic research, financial and external sector statistics, international reserves management, and payment system. He was re-elected as a deputy governor in 2016 for the second term. He holds a MA from Tbilisi State University in math, and also a MA in economics from Temple University, Philadelphia, Pennsylvania, United States of America. So today's lecture will be about crisis and about what central banks can do to prevent crisis or to facilitate negative consequence of crisis. And this year, for the first time, we prepared poll for our attendees, for the audience, with several questions. And I would like to ask, so now we have the poll. You can see there are 2 questions here. The first question is, and please answer it as you think. What do you think? Could the modern economic function without crisis? In other words, can we live without crisis? Can we do something so that we can live without crisis? And second question, is the central bank able to prevent financial crisis? So please answer. We are really interested in what you think. And while you are answering these questions, I would like to say several words about the organization. And also I would like to say that this year, for the first time, we invited not only students from Ukrainian universities, but we also invited students from universities in Georgia and from Polish university. So please use chat to write down where are you from, which country, which city, which university. And also, if you watch us on Facebook, please also leave a message with where are you from, which university, which city, etc. Several words about the organization. Once we are finished with all the technical moments, Archil will have approximately 45 minutes for the presentation. And then we will have 15-30 minutes for Q&A session. The presentation is in English, everything is in English, but there is a possibility for you to hear translation from English to Ukrainian. There is interpretation button, the bottom part of Zoom, so you could switch to Ukrainian if you prefer. During the presentation, you can ask questions, and we encourage you to ask questions to Archil about the lecture or about central banking, about economic crisis, everything that you are interested in. If you want to ask a question, you need to use Q&A button, which is again in the bottom part of in the bottom panel of Zoom. At least that's where I have it. So you ask Q&A, you use Q&A button to ask a question. You can do it in English, or if you prefer, you can do it in Ukrainian or Russian. I will translate this question later. I would not be able to translate it from Georgian or from Polish language, unfortunately. So ask questions either in English or Ukrainian or Russian. Importantly, in the end of this lecture, Archil will choose three best questions which he likes the most. And the authors of three best questions will receive a prize from National Bank of Ukraine, which is a book, which is Ukrainian translation of an English book, Financial Market History, Reflections on the Past for Investors Today, written by David Chambers and Elroy Dimson in 2016. Moreover, if you like the lecture today and you attend all three lectures today, tomorrow, and on Wednesday, you will receive a certificate from the National Bank of Ukraine that you attended this online lecture course. Yeah, I think I said everything which I wanted to say. So we can turn to the results of our poll. So could we live in a world without crisis? 15% of people answered yes, and 85% answered no. And the question, is a central bank able to prevent financial crisis? 25% of you think that yes, central banks can do that. 70% believes that it's like partially can, but not fully. And 5% are pessimists, which think that central bank cannot prevent financial crisis. Okay, so let me give the floor to Archil Mestvirishvili. Archil, please, you can unmute yourself. You can share your screen. The floor is yours. We are looking forward to your interesting presentation, and maybe you want to comment the results of the poll. What do you think, whether we can live in a world without crisis and whether central bank can fully or at least partially prevent crisis? Please, Archil.
Thank you, Sergey. I think this is a great opportunity for us to outreach to the students, and I think also it's good opportunity for students to understand from the first hand how monetary policies are made and what are the factors we are looking at and how we are making decisions. Because whatever you studied during your coursework at universities, a majority of those, at least in economics, will be useful when you may be working for the government, for the central bank, or for private sector, and you try to understand how macroeconomic policies are made, because it will affect your life and it will affect businesses you are work with. So I think understanding, that's very important. There are some differences between theory and practice, and I will mention that as well. So there are some issues in macroeconomics in theory, for example, how money affects inflation, which is in practice is different. Also, there are some differences how models are done in theory and how models are done in practice. But those are something which could be learned later. But at this point, I think what students can do is to study as much as possible. This is the best way for you to work in your life, whether you are in private sector or in the government. And the National Bank of Ukraine is doing a great job to have this opportunity to have during the conferences to have meeting with students. I have done it a couple of times. That was not online, but when I was in Ukraine, and I was always impressed with a very high level of students in different universities of Kiev. And I hope that questions I will receive in the end will be the same level. To go back to the poll, of course, we would like everyone to have life without crisis, that everything goes smoothly as forecasted, but unfortunately, it's not the case. We had very large crisis in 2008, which was a worldwide liquidity crisis caused by the financial sector. And now we have a very significant shock, which is maybe larger than 2008 crisis. It has larger impact on the worldwide economy, and this came from the healthcare. So nobody would expect the shock to come, but policymakers and central bank job to be ready always to some disturbances, and we need to have our instruments ready where shock might come to respond to that. And so we might have regional crisis as well, and we had very turbulent years, and Ukraine had very turbulent years in 2014, 15, 16, and Georgia as well. So our job as a central bankers and as a policymakers in general, including government, parliament, to increase the resilience of the economy. So if shock will hit our economy, so that we will get as less damage as possible. So now I will move to the presentation, which is focused mainly for the monetary policy. So how monetary policy should or is reacting to crisis like this. And we are talking about we will talk on the example of Georgia, of course. I know a few things about what's happening in Ukraine, but I think you know better how central bank is reacting to this crisis. But from the distance, it's very clear that communication of the National Bank of Ukraine has been dramatically improved for the last few years. I also follow National Bank of Ukraine on Facebook, and I receive lots of interesting news from there. And also policies has been dramatically improved. And I think the Central Bank of Ukraine is doing a great job for the country. This is just my personal opinion. So now I'll move to the presentation. I will try to share slides. Okay, I hope you can.
Yes, we can see it. Thank you, Archil.
So in my presentation, I will briefly explain how we do monetary policy and inflation targeting, and then move to the crisis episode and how we have responded to that. So we moved to inflation targeting since 2009. Before that, before 2005, we had monetary targeting, and between 2005 2009, there was transition to the inflation targeting. And when we started 2009, we didn't have good models. By 2013, but we had some models, of course. By 2013, we finalized and we published so-called FPAS, which is a financial forecasting and policy analysis system, which is pretty much set of the models which help us to analyze impact of our policy to inflation, to the growth, and to different macroeconomic parameters, which help us to make our decision better. But our decision on inflation during inflation targeting is based on the inflation forecast. So of course we cannot affect current inflation, which is a result of previous events, but we can affect future inflation. So we do inflation forecast where inflation might end up 4 to 6 quarters from now. And if we see that inflation will be above the target, then we tighten monetary policy. But if we see that inflation will be below the target, it allows us to ease monetary policy. So currently many economists call inflation targeting as inflation forecast targeting, because really our target is inflation forecast. Of course, central bank has instruments to affect aggregate demand, and so we, through our policy rate, which is a short-term interest rate, we affect money market interest rates, we affect lending interest rates, we affect deposit interest rates, we affect exchange rate, and we affect lending. And through those channels, we affect aggregate demand and we affect inflation in the end. So what is our job is that to keep long-term growth close to potential. So inflation is our main objective, but ultimate objective of policymakers, of course, is wealth of the public and how to assure that economic wealth is increasing, which is a long-term economic growth, and within this keep inflation close to the target is one of the necessary but not sufficient factor to have growth close to the potential. So in the end, we have highest possible growth in the medium or long term. And inflation targeting serves best to that purpose, because it allows during turbulent times inflation to be deviated from the target. So and in the end, if there is a shock and you let inflation to be above the target or below the target, but with the focus of medium term that inflation will be back to the target, so you don't lose credibility, then you can do it, and in the end you get you will get price stability with maximum potential growth. But if you cannot allow inflation to be deviated from the target even temporarily, then you have to have very tight policies, which in the end will give you less growth in the medium term or the long term. So that because of that, inflation targeting, which we sometimes call it inflation forecast targeting, it's the best policy tool to achieve price stability and growth, long-term growth close to the potential level. But for inflation forecast targeting, communication is very important, and to have transparency of policy setting. And for that, we also use, we call it forward guidance when we are publishing policy rate forecast, and I will show the graph why it's important and how it works. So now let's move to next slide. As I said, that our central bank can influence short-term interest rates, but we want to have influence over short-term interest rates in order those to be transferred to those we need to have impact on longer-term interest rates, on investment, on the savings, on lending, and so on. So to have that, you need to have some predictability of the short-term interest rate, and it should not be too volatile. And you can see that before 2010, before we moved to the inflation targeting, the short-term interest rate was very volatile. So there was no policy transmission possible with those interest rates. And then it became more or less stable, short-term volatility went down, and some volatility is, yeah, it's okay, it's desirable. But what we had before 2010, where we were targeting money aggregates, that was problematic for interest rate transmission, and also was problematic for long-term lending. Monetary policy rate, which is a central bank rate, then it's, as I said, it's transmitted to money market rates. And on the graph on the right side, you will see the money market rate and monetary policy rate and daily volumes trades. So this is graph useful to analyze whether central bank has maybe tighter policies than policy rates or loose than policy rates. So it's very important that money market rates are close to policy rate. If it's way below, it means that central bank is applying too much liquidity, and if it's way above, it means that central bank is applying too few liquidity. So recently, that money market rate became very close to the policy rate, but this is because we also changed methodology, how we calculate money market rates. We did together with the BRD, and we improved removal of outliers. But anyhow, even before, money market rate was close to the policy rate. And there is a stress in the system. This graph will show you as well that if interest rates on money market are deviated from policy rate, it means there are some problems in the system. Just one graph to show that how policy rate and deposit rates are correlated. Of course, the stronger transmission is better, but you can see that recently there is pretty good influence of the policy rate on deposit rate and on the lending side as well. Of course, there are lots of structural changes. For example, in 2019, we restrict lending in foreign currency to households, and which resulted in decrease of interest rates in local currency mortgages. So there are some structural issues there, but without that, I think there is a pretty strong transmission from policy rate to money markets in previous channel, and to deposits and lending rates. But of course, there is always room for improvement. Since May 2016, we started publishing a path for monetary policy rate, and we explained when we published that this is not what we promised to do. This is just a path of the policy rate, how we see it today based on today's data. And we have meetings 8 times per year, and during every second meeting, we are publishing monetary policy report, and we update this graph. Of course, when we meet during the next meeting, there will be new data, new development, and based on those, then we will update graph. It might look different, but but anyhow, it's very useful because it helps for market participants to understand our vision on monetary policy. Our vision on monetary policy, it's not only current interest rate, but also how we see future interest rates. So when we start publishing, what happened that interest rate on government securities decreased significantly because it increased transparency of the central bank policy. So there is a paper who tries to quantify central bank transparency index. I think the latest update was in 2014, and we also tried to score Georgia where it would be if this paper was updated. And this score is based on different indicators and how Transparency Central Bank, whether it's published minutes, whether it's published information on time, whether it published monetary policy report, and so on, so on. Since 2016, we started to do monetary policy committee meetings in the region or regions of Georgia, and I know that Ukraine also has very significant outreach to the regional businesses or universities. So we are, before pandemic, we used to go in the regions, and we had meeting with students, meeting with local journalists, local businesses, and all, and we try to explain our policies, but also we had very important information and feedback from them on what's happening in areas of the rural economy, which not always easy to see from the capital. So it was very useful exercise, and after pandemic, we most likely will continue. We also publishing financial stability report, which explains what are the risks in the financial sector, what is our vision, and what we are doing to prevent those. Now maybe we'll go to current challenge, which is pandemic and economic shock because of that. Georgia was significantly dependent on tourism revenues, and we used to have 12% of GDP as tourism experts. And I know I met many Ukrainians who were in Georgia for summer or winter holiday. And as pandemic hits most dramatically to world travel, it was not surprised that it hit Georgia significantly. We lost in 2020. We lost 85% of our revenues from tourism. 85 because we had something in Q1, but Q2, Q3, Q4, it was like a 95% loss of revenues. So that significantly impacted our current account and significantly impacted our growth. Last year we had growth minus 6.1. So, and of course, where you have pandemic like this, where healthcare is significantly impacted, when you need to do lockdowns to prevent disease to spread out, then you are bringing new restrictions to the economy, which you have to, because this is a way how to save lives. So then we lost external revenue, but government had to intervene. They had to increase fiscal deficit. They need to support business sectors which were hit by pandemic, but also were subject to some of the restrictions, and they had to support households who lost revenues. So in the end, we had last year fiscal deficit was 9.6%, and this year it is currently forecasted as close to 7%. And for the next year, we need to have, or we will have, fiscal consolidation, and this deficit will go close to 4%. So we lost our external sector revenues, and we had to increase domestic demand. Fiscal had to increase its spending, which of course created pressure on the exchange rate. And exchange rate depreciated significantly in 2020. But before that, in 2019, we also had a different kind of shock, which was specifically for Georgia. From our northern neighbors, we had a restriction of Russians to travel to Georgia. Of course, that was a significant shock for our economy, 2019, which also depreciated currencies at the time. After exchange rate depreciated in 2019, we tightened monetary policy, and you see on the graph on the right side that the nominal effective interest rates were adjusting back to its long-term trend. And then pandemic hit. So we had two consecutive shocks in Georgia. One was this restriction of Russian tourists, and we were exiting from that shock. And during this period, the new shock, pandemic, hit it. So it was, of course, Georgia was very much dependent on tourism. It was very significant shock for us, but it was even more significant because it was back-to-back shock to the previous one. So that put pressure on inflation, and inflation was from 2019 shock, it was declining, but then we had new pressure on prices, and inflation is coming from different sources. Of course, exchange rate puts pressure on imported goods, but also because we have very dollarized financial sector, exchange rate affects domestic prices as well, because cost of the businesses who have debt in foreign currency increases as well. We also had new pandemic-related costs to the businesses, and also lockdowns and restrictions decrease their revenues, but their fixed cost has not changed. And for example, if a restaurant was able to serve, 100 customers, because of the pandemic, they were able to serve 50 customers, but their cost structure, fixed cost, has not changed. So they had to increase the prices, which is unusual where demand is going down, but prices going up. But that was related to COVID. And of course, for us, as for the central bank, the demand is most important. And there we also had mixed signal. External demand was very weak, but domestic demand was strong. So in the end, we had demand, weak demand on balance. It was putting pressure downward on the inflation, but composition of demand was different. External demand was wiped out, especially from tourism. For goods, it declined, but still external demand was very weak, but domestic demand was strong, which was additional channel for exchange rate and then affected prices. So we, unlike to many other central banks which decreased the interest rate close to zero, we, because of high dollarization, we did not have that luxury. So we decreased interest rates where, of course, where demand is weak, where we have losses of revenues, we should theoretically ease monetary policy to support demand. But this supporting demand would eventually put more pressure on the exchange rate, which we already had problems. So we eased monetary policy, but very moderately, and still we had policy rate close to 8%, and our neutral interest rate is about 5.5. So whatever is 5.5, you have tighter monetary policy. If your policy rate is below 5.5, you have eased monetary policy. So we had still tight monetary policy. But later, by the end of last year, we saw that becoming stronger than it was previously expected. So it put additional pressure on the exchange rate. In 2020, it was clear that we need more spending in healthcare, so the government had to increase fiscal deficit, which was previously announced as 5.5. They had to increase to 7.5. So everything put pressure, additional pressure on the exchange rate and then to the prices, and that affected to inflation expectations as well. So then we had to tighten monetary policy even further. So we increased policy rate by about 150 basis points, and now we have 9.5, which is highest since 2008. So now, as our time is running out, now what was our other reaction to the price? So on the graph on the left side, you will see that demand for cash in circulation has significantly increased. There was different issues why it happened. There was a lockdown, and households, they were trying not to visit bank branches or ATMs too frequently, so they try to keep additional cash at hand. Also, government had to increase their spending. They were accumulating their funds from commercial banks to the central bank for later spending. And also banks allowed to credit holidays, 3 months, and which was then extended. There was, for some borrowers, there was additional 3 months. So for that, everybody needed liquidity. So there was a demand for liquidity, and similar was in most of the countries. And on the right-hand side, you will see that interest rates on deposits started to increase sharply, while policy rate has not changed. So we intervened very promptly, unless we have done, because we already saw interest rate on SMEs for small borrowers started to increase, which would be very painful for when you have losses of revenue and your debt interest rate on your debt is increasing significantly. That's putting more pressure on the borrowers. So we had to intervene, and we provided additional liquidity through different channels. And the similar was happening in other central banks. They were trying to flood the market with liquidity. So, and very soon, where we provided additional liquidity, interest rates went down back to the level they should be. We provided local currency liquidity, but we also provided foreign currency liquidity. Government has borrowed through Wi-Fi. They have borrowed about $1.5 billion, and which we were selling to the market. And last year we sold close to 1 billion. Which is maybe tiny number for Ukraine, but the size of the economy is different as well. Our gross reserves now it's about 4 billion, and we are planning to provide foreign currency liquidity to the market this year as well. So as I said, that we were providing liquidity, but we were providing liquidity through new instruments as well. We saw that where there was liquidity shortage in the market, first hit was for SME sector in commercial banks, and for we have this kind of small banks. I don't know whether Ukraine has a similar institutions or not. So we have these microfinance institutions who provide loans, but their maximum amount of the loans they can provide is about $30,000. So they have lots of borrowers, lots of customers, but they're small customers. And we saw that cost of their borrowings in lari increased significantly, and they were transmitting this to their borrowers, and interest rate for SME lending has increased. interest rate on how household has increased. So we intervened, we introduced new instruments, we introduced the FX swaps. We had one and swap was for microfinance institutions, separately for banks and separately for IFIs. We did with EBRD, and I know that Ukraine also did the same with EBRD. And we also expanded our collateral base because there was demand for liquidity. In the end, where markets saw that there will be no liquidity shock, demand for liquidity gradually declined. So to summarize what we have done, so we were providing liquidity through different instruments. We expanded our collateral. We allowed microfinance institutions to have direct channels with the central bank through commercial banks, technically, of course, but price was commercial banks were not able to affect price for microfinance institutions, so their cost of their borrowings went down. And we also allow them to use some liquidity buffers they had. Of course, very important is financial stability, and we allow to use some of the capital buffers which banks have accumulated before the crisis, and those buffers were predominantly created just to be used during this shock. So we let them use those. We also ask banks to increase buffers for possible losses, and we ask them to do it in advance. So whatever the possible credit losses they would incur during that 1 year or 1.5 years, so we ask them to allocate capital for that in advance. So magnitude of shock for bank capital would be known in advance and would be better managed, and this worked pretty well. And we also expanded the program with the IMF, which allow us to borrow more from other IFIs, which were used for liquidity supply operations with to the market. So as I mentioned, we provided not only large liquidity, but we also provided foreign currency liquidity. Of course, reaction to the shock starts before the shock will happen. So you need, as a central bank, as a policymaker, you need to be ready then that some shock will come. You don't know when, you don't know which will be source, but this is the nature of the economy, as a market economy, then that someday you will have shock. It could be external shock, it could be domestic shock, and you need to mitigate impacts of that shock to the households and to the economy. And to do that, you need to have buffers, or you need to have structure of the economy which helps you not to be that dependent on external environment. Unfortunately, Georgia is a small open economy, and we are located in pretty volatile region. So the shocks are happening, and it has significant impact on Georgian economy. Just import to GDP by 2020 was about 56%, and export was 33%. So our trade turnover is close to 100% of GDP. So we are very open economy, and whatever happens in the region or with our trading partners, it has impact on us. But how to mitigate impact, and what are the factors which aggregate the shocks? And of course, this is the biggest challenge is high dollarization, and Ukraine is Dollarization, as I know, in Ukraine is much lower than in Georgia, and I know that households are not able to borrow in foreign currency, which is very useful to mitigate impact of the external shock to the households, especially for the when you are talking about the mortgages. So loan dollarization is still pretty high in Georgia, and we have some policies to decrease dollarization. It's happening gradually, but as said, that Ukraine is ahead of us in this regard. And deposit dollarization, it's even higher than loan dollarization, and we have some new instruments to support decrease of dollarization on deposits, which we are going to implement gradually. Inflation volatility is another challenge, and it's also depending on the structure of the economy. In our CPI basket, food and especially agriculture has pretty large contribution, and whenever the food prices worldwide or because of some events in Georgia changes, then increases inflation. It has significant impact on inflation, so that inflation is pretty volatile. But if you look at medium term, if you like, or long term, if you take like the last 10 years, average inflation was close to 3.5%. So in the medium or long term, inflation, we have the price stability, but for the short term, we have pretty volatile inflation. So the CPI basket has its contribution, but also as I mentioned previously, high dollarization creates additional impact on prices as well. Corporates who have borrowed in foreign currency, where exchange rate depreciates, they try to transfer this additional cost to the customers. Sometimes they can, sometimes they cannot, but in the end, it creates additional pressure on price. And of course, exchange rate and the volatility of the exchange rate. We have undeveloped exchange rate market. There are not many instruments to hedge exchange rate. There are some instruments, but usage is not that large. Corporates, they need more financial education to use these hedging instruments, and we need more market participants, which gradually happening, but it takes time. But before that, during this transitional period, exchange rate is pretty volatile. Of course, our exchange rate is also affected by the developments in the region, and we have maybe the largest trading partner, which has very volatile exchange rate. That has some impact on us as well. I think these are maybe the main challenge we have, which we need to get rid of gradually in order to be economy to be ready, or it's better to say to be resilient to shocks and to crisis. So unfortunately, shocks will happen. Sometimes it will be a large shock, sometimes it will be small ones. We cannot avoid that, but we need to have longer term view. What is our structure of our economy? What is the instruments we have? What we can do if shock will have? How we will respond? And how to protect economy? How to decrease volatility of inflation? How to decrease volatility of the exchange rate? And of course, how to decrease volatility of the economy. I think those are the challenges which we and government and the parliament are working or thinking or should in order to have resilient economies. And as one said, that you should not let good crisis to get wasted. So we need to have lessons learned from the crisis and to went out from the crisis stronger, and to be better ready for new challenges, which we know will come, but we don't know where it will come. I think this is the end of my presentation, and now we can move to questions.
Thank you very much, Archil. Thank you so much for this great presentation. And we have lots of questions to you from students and from the audience. And it is really hard to choose, to choose questions, and then some questions overlap, and people are interested in Georgian experience, people are interested in monetary policy and financial stability. There are lots of issues here in cryptocurrency, which is also an issue, or at least potential issue for central bankers. So let me start from a question by Maxima Damenko. It is in Ukrainian, and I do my best to translate it. The question is the following: Good evening. How and should central banks prevent an emergence of too big to fail banks? So this is a question.
Yeah, I think that's important question. So there are methods how to address those, and because too big to fail, the banks, these challenges for maybe most of the countries, and there are different instruments for that. So we ask systemically important banks. We ask for additional capital, because and for the large two banks, we ask additional 2.5% from their assets to have additional capital. So this is one way to limit impact of the crisis to the large banks, because everybody knows you cannot let systemically important bank to fail. So maybe government can say that they will let it, or central bank, but if this happens, then no government can withstand as they have to, and because the impact to the economy will be much larger than supporting those banks. So everybody knows that, and sometimes it can be counterproductive. Sometimes these large banks can take additional risks, and of course there is a central bank supervision policy to get involved, not to let large banks to take additional risks. Like we have these two large banks which are trading on London Stock Exchange, and these are the publicly traded entities. And this is also helps because they are more transparent, because market would react for everything if they do something wrong. So it puts additional discipline from the market. So market discipline, central bank supervision, additional capital. We also ask additional capital if there is a concentrated sectors, but also there is a new instrument which we have also developed, which is a banking resolution framework. So we have the framework. So if, and I hope will never happen this, but if something happens with large systemically important banks, so how we will react. So we have funding allocated, we have the roles allocated. So how we do when we do, so what restrictions we can impose and so on. And this is a new legislation which we adopted last year, and it called this resolution framework. So there are instruments how to address that, and it should be used for sure to prevent large banks to fail, first of all, but then you should also be ready that if it, in unlikely cases, it will happen, then you need to be ready for that. So that to do resolution with minimum damage for shareholders and for the economy.
Thank you very much, Archil. There are lots of questions about banking system in Georgia. For example, Marina Korol asks, what was the well, the situation in banking system of Georgia, how good it was before the pandemic crisis. And then there is a question by Olga Zaslavska. How does National Bank of Georgia encourage commercial banks to support the economy during pandemic crisis? So I think, in other words, what do you do to help banks to finance economy and to finance real economy?
Yeah. So in terms of the banking sector, so they were pretty healthy and resilient and before the crisis, which helped us during the crisis. And we were criticized by the media or by the businesses, by the politicians, by everyone, by focusing too much on financial stability. And they said that we are very focused on financial stability. We are too obsessive with that, and we limit growth on the lending. So I think that will be similar case maybe in countries, similar countries, and I think that will be similar in Ukraine as well. But still, we did reforms. So we, as I said, that we introduced new capital buffers. We also have, we call it general risk assessment framework. So we assess the level of the management. We also do stress tests, and for that we ask additional capital buffer. We also have capital preservation buffer. So we have lots of buffers to preserve the capital of the bank, not only in normal times, but also during the shock. Because during the shock, you need, it's very important that you have the healthy banking sector, because during the financial crisis, banks become additional burden for the economy. They will increase magnitude of the crisis, or they will help to go through crisis. Of course, we want banks to help to go through the crisis. We want them to finance economy during the shock. This is financial stability, where banks are able to continue their function during the stress period. So this is what we want from them. So we did a number of reforms, and one of them was we call responsible lending initiative, which is now maybe it's very trivial to say that if so bank needs to do minimum credit analysis if household borrower is not able to repay debt, bank should not issue a loan. So which is very easy to say, but to introduce this regulation was pretty cumbersome. We had lots of resistance from the different sectors, for example, from development sector and so on. But now I think it's during the crisis, some politicians even told us that you were lucky because we introduced this regulation in the beginning of 2019. So it was like 1 year or more. It was enough to improve the balance sheet of the banking sector, to make them stronger. So we entered the crisis with very healthy financial sector. So that helped. So this politician said that you are lucky because this crisis came on time for you to justify this very tight policies which you have done before. But I think that the role of and job of the central bank to do, as there is expression, the central bank job is to just to stop music where party is still going on. So unfortunately, where everybody is happy, where there is a nice growth of the lending to the households, to the businesses, but we see this not sustainable, that we will create problems in the future. We need to have tighter policies. Of course, it will upset some of the market participants, but this is why central bank independence is important. So central bank will do whatever is right, no matter all the resistance. And just to summarize, banking sector was before pretty resilient. We also did additional reforms which makes them even more resilient. So the banking sector, they did not have problems. They did not have problems coming from their balance sheets or problems from their capital to finance the economy. There was systemic liquidity shock, which I mentioned in my presentation, and we provided additional liquidity. So there was no problem with that as well. So sorry, what was the second question? I think I covered both, I guess.
Yeah, I think you discussed everything. Thank you. There are questions also which I think are important to discuss. Victoria, for example, asks, dear Archil, could you please share with us Georgian experiences to which tools and instruments do you consider useful for increasing level of trust of population towards central bank policy and I guess commercial banks as well? And Victoria shares some statistics that only 4% of people in Ukraine trust commercial banks, which seems to be a problem. And also let me ask a related question from Valeria. Does Georgia practice the financial literacy in school or maybe among people to decline the financial illiteracy of population? So this question about trust and about financial literacy.
Yes. So I think it's very related questions. So the public and household, they need to be able to understand what the central bank is doing. Of course, it's very difficult because where central bank is focused on the long term or medium term. So we have to, unfortunately, do unpopular things. So where everybody is happy, we need to tighten. So it's very difficult to explain why we are doing that. But of course and we have lots of opposition because when central bank is doing things, it will upset some of them or businesses or sectors and so on. And of course they will try to push back to central bank. That also damages trust to the central bank. But only way for central bank to be trustful is education and financial education. So the public understands what central bank is doing. They can see what will happen if central bank will not act. So what will happen for the future, and they will see importance of that. But a large part of trust is, especially for commercial banks, is consumer protection. So where household or borrower, corporate or household goes to the commercial bank, they need to see bank as their partner. So they don't need to be afraid to sign the contract. So we did lots to improve consumer protection. Of course, it's never is enough. Always more need to be done. So where a household feels safe interacting with commercial banks and they feel protected, then there is a trust to the sector. And I think consumer protection and financial literacy is very important to achieve that. So we had the program of financial literacy, and we have curriculum which together with Ministry of Education, we have implemented. We have integrated some of the financial education into schools, and in different grades there are different curriculums. So there is a one subject, I think it's called society, me and society, and within this subject it's not the separate subject on financial education, financial literacy, but this is within this particular subject there is element of financial education. And where kids will understand better, they will, and younger generations, they will understand better, they will be able to transmit this knowledge to older generation as well. And then for the household to understand the financial transactions, it's very important. They need to have minimum knowledge. But of course, we do not expect everybody who goes to the bank for the loan to be experts of finances or legal. So there is a room for central bank consumer protection or room for the country level consumer protection, so the consumers will feel protected, and in the way less risky customers will also go to the bank, and it will be win-win situation for commercial banks and for borrowers as well. And just to summarize, I think it's in banks' best interest as well to have consumer protection, to have consumer education, and to provide full information to their customers, so the customer will make informed decision, and which improves profitability of the banks and financial condition of the borrowers, and that will be win-win situation.
Okay, thank you very much, Archil. There are some questions about exchange rate, and I think those are interesting topics. It used to be extremely important for Ukrainians. Now we have sort of more or less stable exchange rate, or at least we have not had an exchange rate crisis for a long period of time, but we used to have lots of exchange rate crises. And we have Anna Kapanadze, and I hope it's a representative of Georgian University, who asks, how can we maintain a stable exchange rate? And I would also add, like, should we maintain a stable exchange rate?
Yeah, I think if we be focused on maintaining stable economic growth, if we be focused on maintaining price stability, it will give us long-term stability of the exchange rate. So once you have long-term stability of the exchange rate, then it's possible to have short-term or medium-term stability of the exchange rate. Of course, stability of the exchange rate is very useful, it's a good thing to have, but also floating exchange rate also serves as a buffer and as a protection of the economy, because final outcome and final objective of the policymakers is long-term growth. So we want household revenues to be increased in the real terms, in the long term. This is what will bring what will improve the wealth. So this is our final outcome. So within that long-term expectation of the long-term stability of the exchange rate, which comes through the proper macroeconomic policies, including fiscal and monetary policies, that will ensure long-term stability of the exchange rate. But on the medium or the short term, exchange rate should move according to the fundamentals, and that will also ensure medium-term and long-term stability. And I think that the good way to look at it will be as well that when we talk about the exchange rate stability, what is a stable exchange rate? So the exchange rate is stable where you don't have expectation of its large depreciation for the future. So then it's exchange rate stable. So exchange rate, if it does not move, but it's artificially is kept stable, but you have expectations that it will collapse in the future, it's not a stable exchange rate. And I think that Ukraine went to that as well in, I think that 2005, 2008, or during this period, that exchange rate was kept at the fixed level, if I remember correctly, which accumulated additional risks, and then you had to adjust significantly, which was, I think, very, very painful experience. But since that, Ukraine moved to the floating exchange rate, then exchange rate became more stable. And if you look at exchange rates, managed exchange rate and floating exchange rate, you can also see that those exchange rates which are heavily managed in the medium term and the long term, it's most depreciated currency. And those currencies which are freely floating is most stable is the long term. And just to summarize, I think that our objective should be long-term stability of the exchange rate, which give us short-term flexibility of the exchange rate, and on the short-term flexibility and short-term stability of the exchange rate as well.
Thank you, Archil. So let me ask you the following question. One one potential problem, one potential reason why countries might have crisis is sovereign debt, like excessive sovereign debt. And there is a question by Sergey, who asks what is the best way to finance what is the best way to finance budget deficit without long-term consequences?
Could you repeat?
What is the best? What is the best way?
Okay. Yeah, I think the best way to have fiscal deficit close to the optimal level, which depending on the country circumstances can be different. In our case, maybe it's a 2.5, but now we have 7.5. If you have trust that fiscal deficit will not explode, and we have trust that fiscal is disciplined, which we have, which means that so the fiscal deficit will not become self-sustained. What I mean is that if you have now fiscal deficit that puts pressure on the exchange rate, on the inflation, and then if government will try to subsidize households, businesses too much, that will create additional wave of inflation and depreciation. And then you have to have additional high fiscal deficit, which will create additional problem and so on. So then fiscal deficit becomes long-term, and that's the worst thing to avoid. And I saw today that Ukraine, you have 3.5% announced fiscal deficit next year, and then consolidation will continue, that which is very welcome decision. So this is one. First, to have fiscal deficit according to long-term fundamentals, according to the structure, and so on and so on. But then financing of the fiscal deficit is best to do through internal sources. If you have this opportunity, it's the best to issue government securities and to finance through the market, through government securities. Why it's good? Because then, because fiscal deficit is distribution between the private sector and the private sector. By issuing government securities, you take funds from private sector and give to the public sector. And this is the smoothest redistribution. By borrowing externally, it's not the best way. If you can borrow domestically, I think the best is borrow domestically. But sometimes the magnitude of the need of financing it may be too large, and you cannot borrow domestically, then you go borrow externally. I think that domestic borrowing is best. It also improves market discipline, because if government has very large fiscal deficit, if government fiscal discipline is under question, then interest rate on government securities will increase immediately. So that it's kind of balancing government ability to borrow more. So it limits government to do wrong things. Yeah, so from political economy and from macro point, best way to finance fiscal is borrowing in domestic currency, and best way to do is to borrow on domestic market. If you cannot, then borrow externally. I think the worst case will be to borrow from the central bank. And I don't know if Ukraine is central bank is able to lend to the government. We have prohibited ourselves borrowing from the government in 2005. Since 2005, we are not able to lend to the government.
Yeah, thank you, Archil. So we are almost out of time. Would you have time for another question, for the last question?
Yeah, sure.
Okay, thank you. So there are some questions about cryptocurrencies, and it's hype topic nowadays. So there is a question from Maxim Balaka, and the question is as follows. In your view, what are the prospects of cryptocurrencies, and can digital currencies be a reason for new economic crisis in the future? And let me ask a very related question by by Max Hrichani. There is news about El Salvador, a Latin American country which is planning at least to introduce Bitcoin as a state currency. And the question is, what will happen if cryptocurrency is recognized in one of the state currencies?
I think I'm not the best person to ask a question about it because I don't believe in Bitcoin. I believe that Bitcoin is kind of
bubble.
I don't want to use this word, but it's kind of bubble because so the price of the asset theoretically is discounted revenue of future incomes. And what is the future income of Bitcoin? Where transaction in Bitcoin is very costly. So it's I don't think that it will ever serve as an instrument for transactions, for legitimate transactions. And there are lots of other cryptocurrencies, which call like stable currencies, which could do that. So I think that I believe in cryptocurrencies, which like stable coins, but I don't believe in Bitcoin. I think those has its so those cryptocurrencies, they have future, and especially for cross-country transactions, because when you use a particular currency, it's affected by particular country, but and it's very difficult to track that. It's maybe not as much useful for cross-country transactions, but because there are specific rules. But if rules will be designed one, I think it's Australia and Singapore and other countries are working on this project to use cryptocurrencies for cross-country transactions. I think that has a future. Also, there is some development and possibility for central bank issued digital currencies. Because that digital currencies has its own feature, you can add some contracts or some additional information to this transaction. Now maybe IT or server capacity, it's not that developed, but for the future, these central bank issued digital currencies, I think they can substitute some of the cash, and they can be like these smart contracts. It can work. But for adopting currency which can have volatility 10% in a day as a transaction instrument or settlement instrument, I don't believe it, and I don't believe there is any value behind Bitcoin. There is some value, and because it costs as much it costs, but I don't understand it. I cannot have very firm confirmations that I understand it's wrong, but I can say that I don't understand it, because for me, cost of the asset, it's discounted revenue, it's discounted future revenues, and I don't see that in case of Bitcoin. It can have some usage, but I think that other similar instruments might have more future. But so far we see Bitcoin price increases. It has some volatility, like a few months ago it was, I think, twice more expensive, but it's still there. But I should say that this is not something I understand.
Okay, thank you so much, Archil, for the presentation and for all the answers. Now it's time to choose 3 best questions. We had 9 questions, and I will quickly, repeat them. So the first was about too big to fail banks. Second question was about situation in Georgia banking sector before crisis. Third one was about should National Bank of Georgia encourage banking sector to support economy. Fourth question was about trust in banking sector, in central banking, etc. Fifth was about financial literacy. The 6th question was about exchange rate. The seventh question was about financing budget deficit. And the two last questions were about cryptocurrency, the future of cryptocurrencies, and whether they can be official currencies. So which questions would you choose as three best questions?
I think two important issues, which was the too big to fail or systemically important banks and budget deficit financing. I think those are very important subjects, and I think those were good questions. But for the third one, I just like education. That's okay. I think that's your priority. But I think all of them was very good questions, and it was not easy to choose. I think all of them was excellent.
Okay, thank you so much, Archil, and thank you all of you for attending this online lectures. We hope it was very useful for you. We remind that we have another interesting online lecture tomorrow about central bank communication, and on Wednesday we have a lecture about how U.S. monetary policy affects international economy, affects small economy of like small open economies. So I think that's it for today. We will contact the winners with three best questions today. And also we remind you that if you attend all three online lectures via Zoom, then you will receive a certificate from the National Bank of Ukraine. I think that's it for today. Everyone, have a good day, and hopefully see you tomorrow.
Thank you very much, Sergey, and thanks to all participants, and especially those who asked questions. Thank you.
Thank you. Bye-bye.
Bye.